Overnight, we got some big news that Tesla chose to sell 75% of its Bitcoin. This news comes off the back of rumors that potentially they were going to have a cash flow negative quarter, so they needed to sell their Bitcoin to remain cash flow positive. Now, Elon Musk did say that he is open to the possibility of buying in the future and that it's not a reflection on Bitcoin itself as much as it is a reflection on current market conditions. So that did result in a Bitcoin drop today. We did see a Bitcoin drop overnight, a little pullback. To be honest, it's refreshing because I think the market needed a little bit of a cool down, a catalyst to just slow down a little bit for a second, let us regain our bearings, and then kind of decide, where we go next. So it definitely bought us some time, which I think is a positive thing. Overall, I'm not viewing this Elon Musk saga as too much of a negative catalyst as far as Bitcoin's concerned. I think that Tesla did have very valid reasons to sell. I guess it was just a bit of a shock to some people that this happened. Hopefully he does buy his Bitcoin back again in the future. But in today's video, we are going to be talking about buybacks, but we're primarily going to be talking about tokens and tokenomics because I want to cover exactly what good tokenomics in crypto look like. I think a lot of people, randomly ape into projects, invest in projects without actually knowing how the tokenomics operate, and how tokenomics operate can be the difference between a successful and a failed project, because there's a lot of projects that have very strong tech. There's a lot of projects that are very promising from an ideology perspective, but in practice, they don't perform well in terms of price because their tokenomics aren't laid out in a way that the token itself captures value. So in today's show, I'm going to be running you guys through how a token can actually capture value, good examples of tokenomics in the market, bad examples of tokenomics in the market, and help you guys when you are researching projects to actually tick off this major box in order to achieve success with your investments. So smash a like button for this show. Going to be a massive show. Smash a like to show your support. And let's get straight into it. Before we get into the tokenomics talk, let's talk quickly through what happened overnight in terms of Bitcoin's price response to Tesla selling. And then also I want to run you guys through some altcoin entries that I'm looking at because I am looking at longs right now. And the reason I'm looking at longs right now is simply because still on a short time frame, we are still in a bearish trend, bullish trend. So although we have the macro bearish trend, we are still printing higher lows technically. So even though we tested the range high, this is still a bullish setup. Now, I don't want to go against the trend. The trend is your friend until the end of the trend, as Carl says. So I do want to play this trend, and that means that as per my rules, I'm only looking at longs right now for the pure reason of actually wanting to follow this trend. So what we can see is Bitcoin dropped down to 22,915 overnight. It tested this range high. The range high is an area that I'm very interested in getting a short-term entry. The thing with Bitcoin is if it drops below 22,800, that would be a clear invalidation level for this theory, and you can probably expect us to pull back to the mid-range. So I think playing the 23,000 level is not a terrible play if you have a tight stop. I'm not expecting us to just lose all our momentum overnight because of Tesla. I'm kind of viewing this as an opportunity to reset a little bit, get our bearings on the market, reset potentially for another leg to the upside if we follow bullish continuation. And if we follow bearish continuation, it's okay because we have our stop losses set. We're very well prepared for it. And we can play either direction here in the market. I mean, that is the good thing about trading, that you can play any direction and take advantage of both directions in the market. So yeah, another test of range high is something I definitely see happening. We know the path to 28 can be explosive, but we definitely do need some buy volume coming in. The volume started to dry up just a little bit, and the RSI does look a little bit toppy on the daily. And if we go to the hourly, we have seen a sell-off and a retest of range high, successful retest. Could be getting another one in the near future. In terms of the Bitcoin dominance, what actually happened was Bitcoin is showing a lot of strength compared to the rest of the market, which is unique because what happened was the altcoins actually rallied first. So what happened was Ethereum had a massive rally to the upside. A lot of the other altcoins were kind of the focus of a lot of liquidity after the Ethereum rally because they track Ethereum. But during this latest Bitcoin dip, Bitcoin did capture a lot more liquidity as people were kind of de-risking a little bit. That's why we saw some of these altcoins come down significantly in price, or at least since their highs yesterday, they've come down in price, which resulted in Bitcoin reclaiming this major support of the Bitcoin dominance. This has been diagonal support on the 4 hourly and the daily, and we could see that we tested a few times and then actually broke to the upside. the Bitcoin dominance is approaching key resistance at the 200 MA. That is roughly 0.5% away. I think if Bitcoin retests 23K, presuming that altcoins continue to go down, which we can see in the altcoin charts, which I'll look at in a second, then, this would potentially coincide or show confluence with the 23K level, potentially, being an entry for alts for that short-term pullback, which would bring us back down to this trend line here. But that is kind of like a short-term trade, but definitely something I'm keeping my eye on to see how we react to this 200 MA on the 4-hourly. And if we go to the daily, the Bitcoin dominance is still below that level as well. So pretty major level of resistance here for Bitcoin dominance. Something I'm watching very closely alongside the Bitcoin price. What I want to see is a rejection plus a 23K bounce. That would be my buy condition or my confluence points for starting to get some entries on some of these altcoins. When I do look at the altcoins, I just want to run you guys through a few setups that I'm looking at. Remember, I'm not a professional trader. I'm going to leave that to Sheldon and Kyle. I'm the fundamentalist. Today, we're going through tokenomics. But I do want to go through some of my setups because I have been trading a little bit in my spare time. And I just want to keep you guys updated with what I'm doing. I do this with small money comparatively to the rest of my portfolio. The majority of my portfolio is HODL, but I have a small percentage that I'm trading with and learning to trade with that I want to run you through very quickly. I'm looking at Gala as a potential setup. If we zoom out to the daily, we can see that it hasn't really done much compared to these other altcoins at all. So this is one that I think if it breaks, it can break like significantly. We could see that, it's approaching its major trend line here. It's got the 200 MA quite far away. So if it can break trend and flip the 50 moving average, that would be very, very bullish for Gala. And we know how much upside Gala does have. Potentially, look, let's say Bitcoin does end up going on this big rally, then Gala has 3x potential here, and it's still relatively close to the bottom. Like if we take bottom to its current level, Gala is still like a 18% from the bottom, which is actually, it's barely moved. So I'm looking at getting one entry. Obviously, if Bitcoin drops to 23 and retests, like I think it will, to be honest, 22.8 is still that level that we need to hold as well, which you guys could see I've plotted in using the dotted line. That would be probably my first buy level for Gala, which will probably coincide with 50 to 51 cents. And then my second entry on Gala would be the retested trend. So if it actually did break, we'd probably see something like this and then a retest. I'd be looking at adding in the retest zone for a potential long on Gala. It actually is a decent spot entry in my opinion. So this setup looks decent for spot holders. So if Gala is something you're bullish on, I definitely would not fade DCAing here. I think it kind of looks like a decent entry considering it's close to the bottom. It has that upside potential on the break of trend. Then you've got a few other setups. You've got Phantom coming down a little bit, cooling off. I've got two major zones for that. This lower zone is probably gone for now. It'll probably require Bitcoin to drop significantly into that mid-range to get that second Phantom entry. But this first entry at the 29 zone I'm looking at, you've got Ape as well, which is about to break trend. That's probably gone for now. Probably need to re-look at that, but that would be sitting somewhere around the horizontal of the 5.6 for a Ape long entry. And then Solana as well actually came down, tested the very top of this box here, but I'm looking at that at like $40 to $41. So trying to be stingy on my longs with very tight stop losses. Obviously, that is all conditional on two things occurring: a rejection of the dominance on the 200 MA on the daily and also on the 4-hourly, and then also a retest and a successful retest of range high. If we get those two things, I'll start entering some alts on those levels. So that's just what I'm doing from a trading perspective. Remember, you got to play the trend. The trend right now is bullish on the short term. So if we're trading short term, I dictate anything lower than like a couple weeks length of a trade, a trade over a couple days as short term, then you do want to be following the short term trend. So that's what I'm currently looking at the moment. Remember, if you guys do want to trade at all, there's a link in the description to sign up for ByBit. There's a $4,200 sign up bonus that you can use to sign up and get yourself an account. We're also 10xing accounts live on the show. So if you want to sign up to trade, you can do so using the link in the description and get your hands on that bonus as well. Let's get into the meat of this video, which is tokenomics. This is a big discussion, and I'm going to try and condense it. I'm going to try to be concise, condense it for you guys within 10 to 15 minutes and try and give you, a comprehensive and concise overview of tokenomics, what's good when I'm looking at a token and what's bad when I'm looking at a token. So let's get straight into it. By the way, just to give you a quick update, Polygon gave us an update on the ZK EVM integration. Very cool, using zero knowledge proof tech. EVM compatible, so developers and users can use EVM, so the Ethereum virtual machine, to use and develop, which is cool. And it's the first of its kind. We haven't seen ZK EVM on basically any chain. It's the first one to do so. So that was a cool update for the guys that watched the Polygon show yesterday. Talking about tokenomics today, CoveDuck did a nice thread on tokenomics that's kind of formed a nice structure and basis for my thoughts here. And off the back of that, I'm going to bounce some ideas of what he's saying to give you a comprehensive overview of what I view to be good and bad tokenomics. So tokenomics refers to a few things. Tokenomics encapsulates how the token works, the supply and demand for a token, the mechanisms that govern the token, the deflationary or inflationary aspect of that token, game theory and the incentives behind that token, and basically anything related to the economics of a token. So the word tokenomics stems from economics, and it essentially dictates how the price reacts to both market conditions and the supply and demand for that token. Obviously, we've got the supply side and the demand side, which are both affected by very, very different things. The supply side is basically fully in the token's control. So the project controls the supply side. The demand side is obviously influenced by project-related factors, but is more market-reliant and relies on a lot of psychology. So these two things work in parallel. I'm sure a lot of you guys, are very well aware of how economics work with the supply and demand curve, with equilibrium equaling price in the middle. And that kind of dictates, at the end of the day, the price for these tokens. So, price doesn't operate in isolation. There's many, many factors that go into constituting this supply and demand curve, which ultimately dictates the price of the tokens. Bitcoin is a great example. The reason Bitcoin has succeeded to this date, and the reason why Bitcoin has such a strong narrative, is because it has a total supply of 21 million and a circulating supply of 19 million, and it's hard capped at 21 million. So no more than 21 million Bitcoin can ever be created, essentially forming a hard cap, which means that it is, not inflationary. So no more can be created. So on the supply side, it's stagnant. Obviously, we do get the halvenings, which do result, in a supply drop, and historically that's resulted in a price rise as people price in the impact of the supply decrease from a mining perspective. But by and large, no more Bitcoin ever to be created. 19 out of 21 million is basically the large majority of Bitcoin, and that's why it's considered sound money. Now, obviously, you can get things like the Mt. Gox situation, which can dump tokens onto the market, liquidations, but in terms of creating new Bitcoin, that doesn't happen. Now, maintaining scarcity is a very important aspect of tokenomics. There's three ways you can maintain scarcity. You can fix the supply cap like Bitcoin has done. You can implement burn mechanisms like a lot of L1s have done. You can have lost tokens and tokens sent to the wrong address, so you can have leakages out of the market. Leakages occur when there's lost tokens. Bitcoin probably has millions of tokens or hundreds of thousands of tokens that have been lost or inaccessible, which further contribute to scarcity. And then you also have the burning mechanism. Now, the burning mechanism is a way that a lot of projects actually increase their scarcity. So they'll have mechanisms for the token's supply to be reduced off the market. I think a prime example of this is most L1s, but I think Ethereum is probably the most obvious example at the moment. Because at the moment, Ethereum has a supply growth of 3.7% per year. After the merge, which is the upgrade, the merging of the Beacon chain set to occur in September, that is going live, Ethereum actually has a minus 0.3% supply growth against an issuance of 0.6 million per year. So what this means is Ethereum is putting 0.6 million new Ethereum onto the market, but the overall supply is reducing by 0.3% because the gas fees are constituting a burn of 1 million versus the issuance of 0.6 million. So what happens is every time someone transacts on the Ethereum network, Ethereum is actually burnt in order to pay gas fees. And that's essentially what makes Ethereum in the future deflationary, even though right now it's technically inflationary, because the issuance, meaning the new amount of tokens on the market, ends up being less than the amount being burnt. And this is one way that L1s actually accrue value. It's through these burns. And that's one of the reasons why a lot of people speculate on L1s, because the more users that use an L1, the more people that are going to be transacting, the more of those tokens are going to burn. So it's a very linear way to look at how L1s accrue value. Later in the video, I'll get into some more ways they accrue value because it's not as simple as that. Inflationary tokens are where there's no fixed supply or increasing supply. We see tokens like Dogecoin. The supply is continuously increasing, and these tokenomics can be positive because they do incentivize people to stake in some scenarios. They do incentivize people to validate the network, but and they reward holders for certain activities. But by and large, this means that over time, unless demand can outpace supply growth, the token will gradually decrease over time. Now, in the example of Dogecoin, the supply growth is a lot smaller than the amount of demand for the token, which means the token over time doesn't go down in a linear fashion because not enough supply is going onto the market to actually outpace the increase in demand. But for some tokens where the total supply is rapidly increasing, like we saw with Olympus DAO and Time Wonderland and those rebasing tokens, then we see it can have a massive hit on the market. So always look for the total supply of a token versus the circulating supply, and just verify how those tokens are actually being emitted, and verify to what schedule those tokens are being emitted. So at what frequency those are being emitted. Dogecoin being proof of work means that Dogecoin is actually mined. Now, market cap versus FDV is obviously another consideration off the back of that. Market cap is the number of tokens in circulation times the current price. Fully diluted value is the value of all the tokens that are ever to be created times the current market price. So if we look at a project, let's say Bitcoin, its fully diluted valuation is 500 billion, but its market cap is 453 billion. Obviously, because FDV is adding in addition to the circulating supply, the max supply. So the amount of tokens that are going to be released onto the market through Bitcoin being mined. So sometimes we see projects with massive fully diluted valuations versus the market caps. That can be a red flag. So it's always something to keep your eye on. In fact, I do look at FDV just as intensely as I view market cap, because it's very, very, very important. It's basically the number one step I look for before I invest in a token. So it's a very important measure to actually look at. So the next thing that you have to look at is token allocation. So I said before you invest in a project, look at how these emissions are being released. Look at what schedule they're being released. Look at who is actually getting these tokens. The number one way for you guys to do this and actually verify this is through a website like Messari, where they basically outlay all the research for you in a very condensed fashion. So there's two ways. If the token's not on Messari and it doesn't have a tokenomics section, you can go into their white paper and verify this themselves. Basically, any project that's reputable will have their tokenomics very clear to see, very transparent. And they'll list three things. They'll list the vesting period, so over what period of time the tokens are being unlocked, the private sale and the pre-mine tokens, so how much the team is actually getting, and the fair launch, so who is actually getting the tokens. So if we go into Messari and look at Polygon, for example, you can go. Messari is a great website for this, by the way, and this section itself is free. You click on profile. You can do this for many projects, and you scroll down to token economics. You can view a few things. You can view the launch and initial token distribution. So we could see that 3.8% was allocated to the private sale, 16% was the team, 4% to advisors. It has a nice breakdown of where the funds are actually going. 41% goes to the founders and the project's ecosystem. 22% go to investors. 35.3% go to pre-mined rewards and airdrops for holders and stakers. And then if you click on supply schedule, you actually see the supply curve. So it's an interactive graph of when the tokens are getting unlocked. In the case of Matic itself, 80% of its total token supply is already on the market. It has roughly 20% to be released. We can see that a lot of this is happening on a very slow curve over the next year or so. Which means, there's not a risk of dumps on the market. But we do know that in October, we have our last substantial dump. And our last substantial dump is happening on the week of October 21st. And that's when, quite a few tokens will be hitting the market. I don't think this is a big deal because oftentimes projects price in unlocks ahead of time. But it is something to take note of because often in a bear market, this just adds extra sell pressure on top of existing sell pressure. Which can definitely be an issue in the market. So that's just something to keep your eye on when you're looking at projects. Go through Messari, go through their white paper, and actually verify, what is happening in terms of the unlock schedule with these tokens. Because you don't want to be dumped on. You don't want to become a victim who actually, has their tokens dumped on by VCs. A lot of retail jumps into projects like we saw with Moonbeam. Jumped in the beginning. The tech looked really exciting. It's really enticing to get into Moonbeam, EVM compatible on Polkadot. And the token actually dumped because it had such a significant, such a steep cliff of unlocks in the initial stages that the price simply couldn't withstand the sell pressure. Once again, all of this comes back to supply and demand. So if the price can't withstand the sell pressure, then regardless of how many buyers there are in the market or how much hype a project has behind it, it simply can't sustain. And that's one of the reasons, combined with market conditions, why Moonbeam came down so significantly in price. Do I believe in Moonbeam as a project? Absolutely. I think it's very promising tech. I think it has a lot of competitors. I think it's a difficult space to penetrate, the L1 space. But at the same time, Moonbeam's fundamentals don't necessarily reflect the price performance. And that's the major thing that I want you guys to take note of in today's video, that no matter how strong a token itself looks, it doesn't necessarily indicate success. And that's exactly why you have to look through the white paper and through Messari to actually verify this. Now, the next thing that's very big for tokenomics, and this is probably the most important thing when it comes to tokenomics, is how a token actually accrues value. So it does this in a few ways. It does this through utility, through staking rewards, and the third factor, which we previously talked about, is buybacks and emissions. So utility is the most important thing, because at the end of the day, demand for a token increases if the token is actually utilized, if the network size grows, and if there's more participants on the network. Especially in cases of an L1, the more users that a network has, the more the token is actually utilized and burnt on that network. That leads to both a demand side increase and a supply side decrease through supply burns. So oftentimes with projects, you get a double-pronged effect. You have the supply side actually affecting the demand side due to the rampant speculation we see in crypto. So if a project has a massive supply burn, then this will increase speculation on the demand side because people are front running the fact that those tokens will be burnt. Luna is a prime example of this. It was rising rapidly in price under the expectation or the ideology that UST would continue to increase its market cap. Now, obviously, it didn't work in the end because the key factor at the core of this was UST increasing its market cap. And Luna's key utility was being an algorithmic token that could balance UST's market cap. So the core to Luna's utility laid in UST adoption. Once UST adoption decreased, obviously through the massive short event that we saw and the massive sell event that resulted in the liquidation cascade, then Luna's utility vanished because it only really had one utility. So you do have to view utility in its true sense of what it actually aims to achieve, what a token aims to achieve, and what conditions that token needs to succeed. So we obviously know the Luna story back to front by now, but I think it's a good lesson to actually go back and learn because, the supply and demand of that token was directly impacted by one event. So in the future, how can we actually verify this with a project, whether it has utility or whether it doesn't have utility? Well, I think the first thing to touch on is actually L1s because they're the most common investment. And I think once you understand how L1s accrue value, it makes understanding how other projects accrue value a lot easier. So I think I did a thread on Matic, but Matic's core way it accrues value is very similar to other L1s. So you can kind of substitute any L1 in this discussion here, and it will probably accrue value the same. At least any proof of stake network will. So as I said before, user growth on the network leads to increased transaction volume. So the quality of dApps and applications on the network incentivizes people to come on to that network. Obviously, staking rewards can achieve a similar effect like we saw on Phantom. So the more people on that network means the more transactions on that network, which means more of the base token is burnt. So more in Matic's case, more Matic's burnt. In Phantom's case, more Phantom's burnt. In Solana's case, more Solana's burnt. That's one very simple way they accrue value. But I don't think it's the main way they accrue value. And this is the mistake and misconception I think a lot of people make in terms of L1 value accrual. They think it's solely based on burns. And to be honest, it's not really true because L1s are priced based mostly on speculation and network effect. The price of an L1 or the valuation is based on the assumption that it can continue to exponentially grow its network as more users use and transact on that network. And, there's more connection points between each user. That's, in essence, what network effect boils down to. So the price actually prices in speculation based on user growth more so than it does on the gas burn. Because if you actually look at the statistics, Solana, for example, it actually runs in the negative from a revenue perspective, which is the amount of tokens it's paying to stakers versus the amount of tokens that are actually burnt. And it would take basically a 100x in users for it to become even halfway to becoming profitable. I don't know the exact statistics on hand, but it's basically significantly in the red from that perspective. So why does it pump, and why do people speculate on it? Well, this is one of the key reasons which a lot of people discount when they look at L1s. And that's the more users a chain accrues, the higher demand for the token itself, because it's a key resource within the ecosystem, used not only for gas, but also to transact and interact with other dApps. So a native token to an ecosystem like Matic on the Matic Proof of Stake network or Solana on the Solana network, that then becomes a resource which is primarily used to interact with dApps because it's native. It's the most integrated, it's the most widely accessible amongst a large range of dApps, meaning that it's a token that's often swapped in and out of, and it's a token that's more utilized for that reason. More tokens are bought off exchanges, the more people that are using the chain, because they need liquidity. The more people using Solana, the more liquidity you need, because people will need to buy Solana to use it on chain, and also buy Solana to stake Solana to validate the network. So that's the other way it accrues value. It's through the purchasing of these tokens as a resource within an ecosystem. So a bet on any L1 is a bet on its ability to accrue users. And I think the L1 discussion is most prominent because that constitutes the majority of a lot of your investments. It dictates basically the growth of the entire market because everything stems off L1s essentially, and Bitcoin, of course. But, a lot of these altcoins follow Ethereum. So it's very important to look at how that resource interacts with an ecosystem to verify whether it has good or bad tokenomics. A lot of the proof of stake networks operate in a similar way in terms of tokenomics. Matic, Solana, Phantom, it's all very similar. They're all proof of stake networks. Technically, Solana's proof of history, but they all validate through people staking tokens in a validator node. Those validator nodes pay out a reward in order for you securing the network, which incentivizes you to stake the token, which incentivizes you to lock up the token. So that's a very simple way they all work. But, there's different intricacies between different L1s. So, for example, AVAX, you actually stake AVAX tokens if you want to start a subnet. So we know subnets are one primary way AVAX scales. In order to launch a subnet, you need to provide a certain amount of AVAX tokens. So that's an additional way from a project or a developer side that tokens are actually locked. With Polkadot, we see value accrual through the parachain auctions. You obviously need to buy and lock up DOT in order to launch a parachain. So that's, another demand side factor that impacts Solana and AVAX. So every project has a slightly different way of accruing value, but that is exactly why you got to look into it. And the white paper and Messari is the best ways you can do that. Also watching the show because, I'm going to be doing a lot of deep dives in the future on these projects and breaking down exactly how they accrue value. The next one you have is yield and staking rewards. Obviously, staking rewards are one major factor because, the higher the staking reward, the more liquidity that incentivizes to come on chain. Phantom exploded in December and January because the APRs were so high. There was a lot of, I guess you could call them in hindsight, Ponzi's. Also, a lot of great projects that were paying very high rewards with the price of Phantom rocketing. And that resulted in a lot of TVL coming in because there was an incentive to stake. We saw the same thing happen on AVAX. We saw the same thing happen on Ethereum in the beginning, in the first DeFi summer boom of 2020 on Ethereum with Maker and Aave being launched. So we do see this oftentimes. The higher staking rewards in the beginning, the more TVL. Tron paying 20% on its stablecoin, that has incentivized a lot of liquidity to come into TRX, which is now, the third biggest project by TVL. We saw it with BNB, with all the Ponzi's. We see it time and time and time again. So staking is definitely one way that projects accrue value, but oftentimes it's short-lived. And if the money is fake or the yield is fake or at least extremely short-lived, the positive effects are often outweighed by the detrimental effects very shortly after the positive effects come to fruition. So the pumps may be short and the dumps may be quick. So I guess the onus is on you to get in and out quick enough to take advantage. A mistake a lot of us made. We probably didn't get out soon enough on some of these farms like Phantom and Luna, but that's a great lesson because in the future you'll never make that mistake again because now you know exactly how these staking rewards work in terms of incentivizing liquidity. So a few great examples of how a good example of how staking and locked liquidity works is a project like Convex. Convex is responsible for accruing governance power over Curve. So governance power is the right to vote, and the right to vote impacts what pools they can boost in terms of emissions. So if you stake in Curve, certain pools pay certain emissions to, depending on where the votes are being geared. And the voters are the ones that decide which pools actually get a boost, which pools get a percentage boost, which obviously, as we just verified a minute ago, the higher the APR, the more liquidity is incentivized to go into that pool, the more the assets in that pool go up in price because you're incentivized to buy them, or you need to buy them in order to, LP, essentially. So Convex has done a very, very good job, and it's been one of the most successful ones in this mechanism, because you go in and you lock CVX for a certain amount of time. They use that CVX to buy and lock curve tokens, CRV tokens. That gives them VE-CRV tokens, which they then use to stake to boost certain pools, to give you higher emissions on those pools. And then they use those emissions, those excess emissions that they got from boosting those pools, to pay back CVX holders. And that's how CVX accrues value. We're seeing a very similar mechanism on the more project-specific side from Frax. Frax is a stablecoin which is utilized in Curve, and it's becoming one of the fundamental pillars of the Curve Convex ecosystem at the moment. Frax is actually buying up Convex voting governance itself, which is very cool because of the latest update. I'll probably have to do a future video because it's a very in-depth topic, but FXS basically accrues value from Frax. And we know Frax is one of the major components of the base pools, which increases demand for Frax tokens. And we know that this in turn burns FXS, because the more Frax that are minted, so the stablecoin is Frax, the more FXS are burnt. So this is a very good example of tokenomics. In fact, I think Frax have top 5 tokenomics in the game. That's my honest opinion. Some of the best DeFi tokenomics in crypto are Frax, and I put Convex in that list as well. These are definitely 2 to keep your eye on if you're interested in DeFi. Something I'm bullish on. Yeah, of course, it's come down in price, but that didn't actually change the narrative for me. In fact, the narrative with the latest announcement is more bullish than ever, because they could potentially end up becoming their own chain, right? Then they can roll out a Frax swap, Frax lend, potentially handle their own ETH derivative. So this is a very cool project. Sam Caseman's the founder. He's doing some great work on the Frax side. So something to check out. Okay, this deserves a dedicated thread and video now. I've just decided it 100% needs one, because it's very, very cool. And as a DeFi nerd, Frax and Convex, are 2 very, very cool protocols in the way they operate through their locking mechanisms. They're 2 examples of mechanisms that actually work or have worked thus far. And I think, have shown the demand is there for these mechanisms, whereas we saw demand for mechanisms that didn't work last year through rebasing tokens. Obviously, Wonderland, Time Wonderland is an example of, and Olympus DAO, example of tokens that didn't succeed because they were emitting to death, and tokens that emit to death end up dying because they're emitting or diluting the supply more than the demand can keep up. When the demand for time dried up, the price crashed because it just kept rebasing itself to zero. Similar thing happened actually with Luna with the death spiral. Similar thing ended up happening with Olympus DAO. So just keep your eye on rebases, because the model basically doesn't work because it just relies purely on game theory. We thought it may work. I took, a few punts on Wonderland, very small punts, but it didn't end up working because it just proves that you need a constant supply of demand coming in to actually underpin price growth, which is not something that you want. Because, it does rely on speculation. And I think Kovduck does a good job of explaining that here. He says, crypto is largely driven by memes, don't fade them. I would agree. Just as crypto is largely driven by speculation, don't fade the speculation. So don't confuse speculation for good tokenomics. Oftentimes, like with the Time Wonderland, a project will pump because there's speculation, but the tokenomics, the underlying tokenomics actually aren't that great. So memes are a fundamental driver. Speculation is the main driver of crypto at the end of the day, being an up-and-coming asset class. Your job is to navigate which ones can actually cut through the speculation when push comes to shove. In a bear market, which projects have the strongest tokenomics to survive. And hopefully the tools, or at least the ideas in today's video, can give you a better idea of how you can actually do that. Just to give you guys a quick summary, look at the FDV. Look at the total market cap on CoinGecko. That's the first step. Then go into Messari, go into their white paper, look at how tokens are being emitted, look at how they are being delivered to the team, look at what percentage are being allocated to stakers. Then the key question becomes, I think the main question at the end of the day is, what is the utility behind the token? How does it accrue value? How will it accrue value in a bear market? And in a bull market, how will the mechanism actually work? And is that mechanism better than other similar projects? So if you're investing in an L1, are the tokenomics stronger than another project? that is something you have to weigh up, because at the end of the day, investing is all about opportunity cost. If you have a stronger set of tokenomics, then you're always going to pick that over the one with a weaker set of tokenomics if the growth potential is roughly similar. So that's definitely something you have to weigh up. I definitely want to answer your questions because it's quite an in-depth video. So what I'm going to do is go over to Instagram now. There's a link in the description to my Instagram. It's Miles_Deutscher. And I'm going to go live on Instagram and answer some questions and hang out with you guys live for like the next 20 minutes. Also, if you aren't following me on Instagram, make sure to give me a follow. I'll follow back a few of you. In fact, I've even got a scammer here that just followed me called Craig Perco Coco. He forgot to change his username. So I won't be following him, but if you give me a follow, I'll follow a couple of you back, show the love. And yeah, head over to Instagram for a Q&A that I'll be starting in roughly 30 seconds. So yeah, follow my Instagram, link in the description, and we'll hang out and I'll answer some questions. Thank you guys for watching the video. I'll catch you over on Insta. See you in the next one. Peace out.